we generally deal with two kinds of people. One is the buy side and the sell side. So basically we are a knowledge sharing forum where our idea is to eliminate the space between the people who know and the people who know on the lesser side. So we reach out to buy side clients, to sell side clients, and we organize over 150 events in a year across India and outside India as well. So to start off with, we are having Moorad Choudhry with us. So I'll be just making Moorad Choudhry presenter here. So Moorad, it is over to you now.
Thank you very much indeed. Good morning, everybody, or should I say good afternoon. Thanks very much for inviting me to present this webinar to you on trends in bank treasury risk management. I'll just get the slides up. Bear with me 1 second. Okay, is that, hold on a second, just get this in the right order. Righto, is that visible to everyone and can everyone hear me? Can I just get a confirm from the organizer that it is all good and you can see everything including the slides? Yes? Okay, I'll take that as a yes. Please, can someone drop me a line if that isn't the case?
Yes, I can hear you and see the slides.
Fantastic. Okay, right. So we're going to talk today for half an hour or so on global trends in bank treasury risk management. In fact, we could have a whole week's-long seminar on this. I put the title down there, BTRM webinar. It's something I've been doing a few years now when attending conferences or workshops in the industry, talking about the impact of Basel III on bank balance sheets, bank business models. Basel III is this is now old hat. There's nothing new that I'm saying, nothing revelatory that I'm saying. Basel III has much greater impact on business models of certain banks, a large number of banks, than just mere regulatory requirements. It's much more impactful, if such a word exists, on the balance sheet, mainly with respect to not just its more onerous capital requirements, but also the liquidity requirements. And previously, if one had to follow best practice for capital and liquidity, and indeed the operating model for governance of the balance sheet, which is a very related topic as well, you know, how a bank organizes its asset liability committee. Previously, the bank would have just put in place what it needed to do, but now the requirements are so onerous that certain business models and certain business lines within a bank are no longer really viable, not from a shareholder value added perspective. So in that case, banks need to adjust their business models. Now, perhaps the biggest example of that taking place only on a slow basis is to be observed in the European Union, because there, a large number of banks, especially in the continental Western European Union, are very reliant on central bank funding, the ECB, with its very long-dated repo facilities at cheap rates. They're very reliant on that to continue term funding of the balance sheet. A lot of banks in Europe are only compliant for net stable funding ratio, the long-term liquidity metric of Basel III, because of the use of central bank funds. Net stable funding ratio isn't actually a requirement until 2018 in the European Union, and they're going to have a kind of glide path into 100% compliance. But nevertheless, that shows us that a lot of these banks haven't adjusted their funding structures to the point where they are self-reliant for funding. So, and that in itself is something to not necessarily be concerned about. Well, yes, to be concerned about. If one thinks central banks should be involved in funding the main business of a bank, then I suppose it is something to be concerned about. Okay, so back to this afternoon's webinar, Global Trends in Bank Treasury Risk Management. What we're going to talk about today is Basel III, as I kick off with, then the concept of strategic ALM, and then of course some issues on human capital requirements, because actually we have to upskill with the quality and capability and technical capability of our staffs in what I call the risk management triumvirate at a bank. The risk management triumvirate are those departments, those people who work in the Treasury, the risk and the finance departments, the triumvirate of the three teams in the bank that are responsible for balance sheet risk management. And you can imagine with the greater needs, regulatory, reporting, liquidity, balance sheet structure, with the greater needs of Basel III, every bank has to ensure that its people are fit for purpose to ensure compliance. So there's also a large human capital requirement element of this. First of all, just some background for you. How is Basel III adopted into legislation? Remember, Basel III is just a guideline. It's not law. It's not any country's law. It's the Bank of International Settlements, based in Basel in Switzerland, and they produce consultative papers fairly frequently these days. They produce a consultative paper or a set of guidelines, and then national jurisdictions in each country would decide, yes, we'll adopt these, and they would implement them into legislation. Okay, so for example, as you see there at the top, Basel III is a global set of capital adequacy standards, not just capital adequacy, also liquidity. And it also talks about things, the wider remit of Basel III talks about things like interest rate risk in the banking book and funds transfer pricing. So it goes beyond capital and liquidity. In the European Union, that's a piece of legislation called CRD4, okay? If you're a European Union country, an EU country, you will have that in your national legislative framework because of CRD4. Outside of the world, it requires local implementation. So for an individual country would have to enact legislation that said banks will have to follow what's in the guidelines in Basel III. Now, some countries adjust what's in the Basel III document, the BIS document, to their own requirements. In some cases, materially. The USA and Switzerland are two examples of countries that have actually made what I would consider material changes to the requirements. In some respects, they've made them more onerous. So you don't have to just, some countries simply adopt Basel III pretty much what is written in the original document, and others make adjustments to them. The EU version is more or less what was in the original document, whereas some countries, like Switzerland and the USA, have their own have added their own bits to it. BCS members, the members who are involved in drafting these consultative papers, are there on the slide for you. Some countries haven't adopted it. I'm thinking, not related in any way, but off the top of my head, I can think of Russia and Brunei as two countries whose regulators currently haven't adopted Basel III, i.e. they don't require, at the moment, they don't require their banks to adopt Basel III standards. So that's quite interesting. I dare say in due course they will do. I think every jurisdiction will do in due course, because to not do it would be to suggest to the rest of the world that the banks in your country weren't quite up to a perceived minimum regulatory standard. So therefore, I think in due course, just about every country will adopt it. Okay, the capital framework in the UK looks like that. This actually is not very much different from what's in the original document. Here's some detailed difference here. The reason I've got this slide here for you is just to have a look and see what's required in the UK. So remember I said priority Treasury agenda for this webinar. What's on the bank's Treasury agenda, if you like, for priority? I want to look at this. We have buffers on top of buffers here. We've got the Tier 1 buffer, that's pretty standard, to be made up of core equity Tier 1, additional Tier 1, and Tier 2 instruments. In fact, all of capital now is just that. Core equity, core Tier 1, equity and reserves, additional Tier 1, things like pref shares, for example, or a new issue of shares, obviously, and then Tier 2, which are long-dated funding. By long-dated, I mean in some cases 5 years onwards, usually 10 years non-callable. That could be a bond issue or a loan from a parent company, for example. So that's Pillar 1 and Pillar 2 buffers. Then we have additional requirements that come about as a result of Basel III. There's the counter-cyclical buffer, which can be set between 0 and 2.5% of the balance sheet. Between 0 and 2.5% of risk-weighted assets, which at the moment in the UK is 0. But the regulator has the powers to increase that if it deems necessary. Then we have a systemic buffer that is relevant to what are called systemically important banks. So that's actually a set group of the largest banks in each country in the world. That can be between 0 and 5%. Then we have a capital conservation buffer, which again, the PRA, the UK regulator, may impose if required, for example, which would prevent a bank from paying out dividends, for example. And then you've got the PRA buffer on top. That's again specifically for a bank if the PRA deems it. You can see there's quite a lot of overlay, and by the time you've worked that through, what every bank has to do, you're well above the minimum 8%. In fact, I can well see that in a global systemically important institution, that could get up to approaching 20% of liabilities, balance sheet liabilities. So that's quite onerous from what was observed in the past, even though a lot of banks in the past would have had a minimum of 15% or so anyway. Okay, so what are the new Basel liquidity rules? The Basel Committee has adopted a three-pronged approach to address the weaknesses in bank liquidity management that were evident during the financial crisis. They originally published their principles for sound liquidity risk management shortly after Lehman's went, actually. It's an interesting time. They've got two new quantitative calculations, the liquidity coverage ratio and the net stable funding ratio. I mentioned the net stable funding ratio to you just at the start here. The LCR is in place from January, and the net stable funding ratio comes in place from 2018. There's individual papers written on those two metrics. Those two metrics, one is the short-term metric, liquidity coverage ratio. That basically says a bank has to have sufficient liquid assets, genuinely liquid assets, to cover a calculated 30-day stressed net outflow from the bank. So what does that mean in practice? So let's assume we enter into a stressed period in the marketplace, or indeed for our bank individually. So it can be an idiosyncratic risk, or a market-wide risk, or a combination of both. What do you think would be the outflow of liabilities in your institution over the next 30 days? So ultimately, this is an assumptions-based calculation. Okay, we don't know, we can't predict, and if this time next year there is some sort of geopolitical event or some market crash, how much funds would come out of the bank? We don't know. Okay, that's like asking for this weekend's lottery numbers, really. But so what we have to do, we have to estimate. Excuse me. We have to estimate this using various assumptions and stress factors, and whatever that number is, 1 million, 10 million, 1 billion, we have to have sufficient liquid assets on the balance sheet to cover that amount. Okay, so the assumption being, if the market's closed for 30 days, you can still be funded without falling over for liquidity reasons, for funding reasons, for the next 30 days. So that's the liquidity coverage ratio. Net stable funding ratio is also assumptions-based. It makes assumptions on the required stable funding factor of a bank, of its current balance sheet assets, and what is available stable. That stable funding is funding that is longer than 12 months. So NSFR, net stable funding ratio, is a long-term metric. Okay, and as I mentioned at the start, some banks are having trouble being compliant with its 100% requirement today, and in the EU, the availability of central bank funding from the European Central Bank has got a long way to assist them to make sure they are NSFR compliant. Okay, as well as the actual metric calculations and requirements, Basel published a set of monitoring metrics to assist supervisors in the analysis of bank specific system-wide liquidity risk trends. Now, what does that mean? It means that banks have to have a much more fit-for-purpose suite of liquidity metrics that they monitor as well as report every month. Okay, and this is something I spent a lot of time doing in the days which recently is when I started my new appointment at Habib Bank a few months ago. Up until then, I was spending a lot of time presenting on things like the best in class or the best practice suite of liquidity metrics, the how to report and monitor liquidity. It's an art, not a science. Certain metrics are more relevant for other banks than others. If you're a globally systemic multinational bank, how you report liquidity will differ from, say, a single branch, retail banking, or residential mortgage institution in one country. Okay, and everything in between. So the art now is the requirement now, the skill required is to make sure that you understand the balance sheet as well as you can with respect to the metrics you use to report its liquidity state. Okay, so that's basically the challenge for banks. And as I said, there's a lot of work has been done on this, and a lot of ways you can cut this cake. Okay, so it's one of the key issues for treasurers now. I would say related to this, two key issues are ALCO governance, how you organise and operate the asset liability committee, what powers, what delegated authority from the board does it have, and the second one is how you craft its liquidity reporting, what should be in that deck. So these are two priority agendas for treasurers or bank treasury departments. Okay, so that's Basel, and you can imagine there's been a lot of chat and conversation and debate on the requirements. Now the law, we have to abide by them, we're in the banking industry. So it's simply a case of being compliant. I mean, the first thing a bank has to do is to be compliant with regulatory requirements. That just is a given. Okay, taking that on board, so we are compliant. Of course, remember, the balance sheet isn't something that is just given to you, although in some cases I seem to observe banks seem to operate that it is. It should be something that you want to structure over the medium term in a way that suits you. In other words, an optimized balance sheet. Now that leads me to the next priority item for Treasury partners, which is the concept of strategic ALM. Okay? Strategic ALM is my own expression, and I define it as basically an approach to asset liability management that is much more proactive than it has been in the past. Asset liability management as a discipline was written back from the 60s onwards. Okay, it's been around for a while. The concept of ALM, the ALM desk is usually within the Treasury Department, and it's basically managing the mismatch for funding term, interest rate basis, and FX that what exists on the balance sheet between assets and liabilities. That's basically what it is, asset liability management. It's reasonably straightforward discipline to understand and to apply. However, the practice up until the crash, and even now today in a lot of banks, is that the ALM manager is a reactive person. The business lines go out and structure the balance sheet. In other words, they make loans, they lend money to customers, and they take in deposits. And usually it's different departments doing that. One department lends money, another department goes out and looks for deposits from customers. That balance sheet is then created as a result of this front-line business activity, and then the ALM managers take this balance sheet and then they manage it going forward. Okay, that's quite a reactive approach, isn't it? The ALM manager is given a balance sheet. In other words, they don't have any real say in what the balance sheet looks like today and what it's going to look like a year or 3 or 5 years from now. Strategic ALM is the concept of being much more proactive with respect to ALM. In other words, the risk management triumvirate. Remember my little triumvirate, finance, risk, and treasury? They have to be much more closely involved in what the balance sheet looks like from the origination stage onwards. So it's much more proactive. As the slide says there, it's a single integrated approach that ties in asset origination with liabilities raising. So the two departments that do both have to talk to each other. There has to be a much more coherent, integrated, strategic view on what the balance sheet should look like, so what type of funding we have, what type of lending we do, and the two departments talk to each other. There's much more closer knit organization. So as I said in the second bullet point, no more siloed organization. That's the key. That's what strategic ALM, okay? It's a simultaneous process. The type of lending you do.
Excuse me, Professor. So we are getting a few queries. They are asking for this screen to be in a slideshow mode. So
sorry, you're getting a few what? Sorry.
Yes, a few of the attendees are asking if the presentation to be in a slideshow mode. If you can just get the presentation in the slideshow mode, because
should I switch to slideshow?
Yes, switch on the slideshow F5.
Is that better? Is that better?
Yes, this is better.
So that's okay, is it? Hello?
Yes, that's okay. That's perfect.
Okay, right. So
you can go ahead.
Okay, thank you. So in other words, to continue, the asset type, the type of lending you do, whether it's residential mortgages or commercial mortgages or project finance or trade finance, the type of lending you do is relevant and appropriate to the type of funding you have for it. And equally, it's other side of the same coin, the type of funding you raise and source is appropriate to the asset it's funding. Okay, to give an extreme example, so I can't imagine a bank would do it today, but to give an extreme example, you wouldn't be using very short-term wholesale money market funding to fund project finance lending or infrastructure finance. In other words, you would be funding a 30, 40, 50-year asset type that's illiquid and on your balance sheet with overnight funding. That's an extreme example. Okay, or you wouldn't fund lending to South Korean companies in Korean won by borrowing US dollars and FXing it. Okay, although again, that's something I've observed as well. So that's what I mean by strategic AM, and it's basically an optimization exercise. Because remember, what you've got more than one stakeholder to keep happy when you're in the Treasury department or when you're in the bank. You've got to first, as I said earlier, you've got to meet the regulatory requirements. You've got to also be optimized for your own P&L. So that's the net interest income, net interest margin aspects. And then, of course, you've got to optimize for customer franchise aspects. If you set yourself up, let's say your primary customer source is small and medium enterprises, you've got to obviously carry on lending to them, even if your funding type wasn't necessarily the most appropriate. So this is an optimization exercise. You've got three competing areas, and you've got to optimize all of them. The reg requirements, your own P&L and balance sheet aspect, and your customer franchise. And this requires strategic ALM. You've got to be much more proactive in the way you originate assets and liabilities on the balance sheet from an ALM, from a balance sheet management perspective. We're much more proactive to ensure that you can optimize a balance sheet from those three perspectives. Okay, that's strategic ALM, and I think it's the imperative, not just for Treasury departments today, but for banks. Banks as a whole, you need to optimize the balance sheet because you have the onerous requirements of the regulator, Basel III, and you have your own stakeholders, shareholders, customers to keep happy as well. Without strategic ALM, you're not going to be optimized. So what does it mean in practice? It means the Treasury department is more closely involved in the ALCO process and in the origination process, and vice versa. The two parts of the bank, the customer-facing side and the balance sheet management-facing side, are much more closely interacted and with each other and communicate better with each other. This is a very important key priority for banks going forward. And then some principles for liquidity funding. Actually, this is just drilling down from the earlier slide on Basel III liquidity. Assess the funding structure on an aggregate balance sheet approach. That's actually connected with the previous slide. You should consider what the proportion of your liquid assets versus illiquid is on the balance sheet. This is actually now required as a result of Basel III liquidity LCR, the LCR metric, liquidity coverage metric, liquidity coverage ratio. But it's actually good practice. A bank would have to always be, in my personal view, although I know one or two people don't agree with me on this, but I think a bank has to go beyond what the LCR metric requires, what the regulator requires. If by having a balance sheet of 10%, well, the balance sheet was government T-bills, fairly liquid asset class in most countries, then is the 10% the right number? Well, LCR will give you a number that to be regulatory compliant, but what is the right number for your business model, for your anticipated stress events? Is it bigger than that? Or is it actually smaller? Sometimes a regulatory requirement could be overly conservative, and you could make a case where, look, we need to have this liquidity because the nature of our, point of our customer base for deposits, and they've been with us for the last 50 years, for example. So you can make a case where the LCR calculation is bigger than it needs to be, but generally speaking, I would suggest the bank should always have it as its minimum and have a buffer on top of that, so it's always comfortably above what the regulator would require. On the liability side, remember strategic ALM, we're still talking about strategic ALM. On the liability side, we need to have robust long-term liabilities, funding, okay, and we need to actively manage it. Okay, there should be a liability strategy. Hands up all of you in the banks out there that have a coherent, integrated liability strategy, medium term, 2 to 4, 3 to 5 year, that discusses exactly what the optimum funding mix is. How much of this type of funding, how much of retail deposits, how much of corporate deposits, how much of wholesale funding. What's your strategy for that? So you need to craft this strategy, put it in place and implement it. You need to have diversified funding sources, no concentration. These are all old traditional principles of banking. And an active liability management program, for example, perhaps buying back debt that you issued at a higher rate before. You do allies, no concentration. You need a wide investor base, perhaps the private placement program, so on and so forth. This is not an exhaustive list. What I'm saying is you need to have an active liability management program that always keeps the balance sheet optimized for strategic ALM purposes. And on the asset side, of course, a whole host of factors. You know, in higher liquid assets to share the balance sheet, that's given to you by LCR, but I just commented now on that's just a guide. It should usually be, in most cases, will be a minimum. You don't try and de-link the bank's sovereign risk exposure connection. The liquid asset buffer doesn't actually have to be government bonds. I get this a lot at conferences. You know, there's a shortage of assets, a shortage of risk-free assets. You know, the assets don't pay as much, which is true. You don't expect the liquid asset buffer to make money. I shouldn't expect the liquidity portfolio to be a P&L generating business. Otherwise, I've got the wrong business model. But it doesn't have to be government bonds. If there's a shortage of them, what about cash at the central bank? Now, I must admit, cash at the central bank doesn't work if you're in the Eurozone with the European Central Bank, because they will charge a negative rate, or indeed in Switzerland because the Swiss Central Bank has a negative rate. Outside of those jurisdictions, granted they are important large jurisdictions, Eurozone and Switzerland, but outside of those jurisdictions, cash at the central bank is always your best bet for the liquid asset buffer. And then, of course, actively manage the loan book or the asset side of the balance sheet in line with original standard principles, you know, asset quality, origination quality, leverage, you know, don't maximize leverage, assets funded by the appropriate type of funding, as I mentioned earlier, and of course your business model, your bank's operating model. Does it still retain the comparative advantage that it did before Basel III was implemented? Okay, the last point there, asset encumbrance becomes more and more important the more secured funding you do, whether it's secured by with repo funding, securitization, covered bonds. Both the rating agencies and the regulator keep an eye on the asset encumbrance ratio, and if it gets to a point, certainly if it's above your peers or viewed as high, you can get marked down. So it's a bit of it's a paradox, isn't it? Secured funding is seen as quite a good way to fund the balance sheet, but at the same time, the more you do it, the more you encumber your assets. So if there was a wind-up situation, there isn't anything in the pot for unsecured creditors. So you're kind of marked down from a balance sheet strength perspective. So there's a paradox there to watch. Secured funding is good, but only so good. And once you start encumbering your assets too much, it becomes an issue. So again, that's something to monitor quite closely and have an asset encumbrance policy. That's an important policy document for banks that do secured funding. Here's a cutout and keep policy guide for the asset liability mix, but no great shakes there, no great revelations, all very good motherhood and apple pie stuff. On the asset side, asset quality, liquid assets, leverage, asset encumbrance, all that stuff. On the liability side, we mentioned earlier, diversity of funding, widespread of investors, funding types, stability of your customer funding base, manage your mismatches, good level of capital and deposits as given by the regulator and by your own business sense. And then I've got the last point, the minimum use of complex funding instruments, not necessarily because there's anything wrong with them, but there might be some issue with them in a stress situation. So when I say minimize, I would actually, to be honest, I would probably modify that a bit. And I think, you know, going forward, it's not so much minimize, but understand the use of complex funding instruments. That's probably a better way to view this. Right, on the last point then, human capital requirements. Treasury risk and finance are the balance sheet risk triumvirate, as I showed, my little triangle, and they need to have genuine aggregate level ALM discipline in the blood. In other words, it's something they need to be aware of. Actually, they need to work together to ensure a strategic ALM perspective. That's the important point. And this requires a combination of training and experience. Upskill your staff or train them up so they are exponents of strategic ALM and understand how the three departments work together to ensure an optimized balance sheet. That's basically the key training requirement for Treasury risk and finance departments in banks today. Understand what strategic ALM is, what optimized balance sheet requirements are, and work together to ensure that. And that's a training requirement. As I say at the bottom there, it requires a combination of training and experience, and formal training courses, more informal peer group seminars, workshops. Talk to your peers, attend seminars and workshops and conferences as much as possible. Talk to your peers, read about the subject, read what's out there. Formal training courses, whether they're long courses or short courses, workshops, different providers, all very important. Very important to be aware of what's in the marketplace. People use this expression, best in class or best practice. What does that mean? Well, best in class to me is fairly self-evident. It means of a class of people, you're the one with the highest mark. How you actually mark that, that's another issue. best practice, people ask me, what does that mean? That means whether in an industry in a set of peers in an industry, they'll all be doing various risk management tasks in their own particular way that they seem fit. Which one is the, inverted commas, best one? I would suggest best from a risk management perspective is the one that's the safest, the most sustainable, the most long-term. So what is best practice? Well, if I don't meet my peers, attend seminars, attend training courses, take qualifications, talk to my peers, and read about the subject, I won't know what's best in class. So the training requirement is multifaceted. There's the formal course, the long course, the short course, the qualification, the professional qualification. There's also seminars, workshops, industry events, talk to the peers, read about the subject. It's multifaceted, and it's very important for Treasury risk and finance teams to be undertaking today. So that's the training requirement point. And I think that pretty much wraps us up for the webinar this morning, or this afternoon I should say. I hope that's been of interest to you. We have some time for questions, I believe, if we have any.
Right, so you have the chat box, you can type in your questions there, or if you have a question, you can raise your hand, I can unmute you. So any questions as of now? If there are any questions, you can raise your hand. There's an option to raise a hand, as well as you can type a question. Any questions? So yes, so there is a question from Senator Stephen. He is asking, what are the qualifications to be in Treasury management?
That's a very good point. That's a very good point. You know, it's really interesting. There isn't that industry, that culture didn't develop in the way, say, that other professions like accountants or surveyors or lawyers developed. Where one had to get that qualification either at the beginning or on the job before one was considered able to do it. In the Treasury business, so bank and liability management, there was never a formal qualification. I don't consider the Association of Corporate Treasurers to be, well, it was never required. Lots of, probably the vast majority of treasurers and banks don't have the ACT. See, equally the ACI, the dealing certificate, that's very specifically for people, for example, in the FX market who are dealing. There was never a formal Treasury qualification. I mean, the BTRM aims to be just that, but there was never a formal qualification. If you join a bank and you want to work in the money markets desk or the Treasury department or the ALM desk, I wouldn't say there is a specific requirement. It helps to have, obviously, a numeric degree, to have some understanding of the marketplace, but really one is joining a bank and then joining the Treasury department. It's not that common that the Treasury department specifically goes out and recruits. So there isn't a specific qualification. I would suggest anything, a professional qualification from a finance institution, for example, the Chartered Institute of Securities Investment or the IFS University College. There's lots of them around the world. The bankers' associations have their own qualifications. I know that the Malaysian Bankers Association has its own template. Lots of them around the world. It helps to have a professional qualification to work in the Treasury area or in the money markets or ALM desk. But there's no specific professional qualification that is required to be in Treasury. Personally, I think that culture needs to change. We need to become more like accountants and lawyers and doctors, etc. So, that is necessary, and something like the BTRM is aimed at plugging that gap. Okay. Right, that's about time for me anyway, actually. So if there's no further questions, I'll bid you a good day, shall I?
No, but Professor, there are a couple of questions coming in. So we are getting questions from Shivang Srivastava. So he is asking, On strategic ALM in a bank, one example was mentioned was not to fund project finance loans on overnight funding. What could be the other examples?
I missed that. What was that question again? Sorry.
Yeah. So he's asking on strategic ALM in a bank. One example you mentioned was not to fund project finance loans on overnight funding.
Okay, I get it. I get it. Yeah, I get it. Okay, look, you know, there's lots of such examples. I mean, I give the other example: don't fund Korean loans with US dollar borrowings. You know, don't fund fixed rate lending with floating rate borrowing because that will give you a P&L risk. You know, net interest income exposure. There's lots of examples. You know, if anything with a mismatch. If I were to lend someone 5-year fixed rate, fixed term, and I funded it by 5-year fixed rate, fixed term, I would be matched. Anything that isn't that specific match in that same currency is a mismatch. Forgive me, I'm going to have to leave now because of time constraints to do with the family. My apologies. I suggest if there are any further questions, if the organizer, if you could email them to me, I will answer them in detail this morning and send them back by email. Okay.
Right, Professor Choudhry. So the questions which we have received, and if there are any further questions, we will request the attendees to mail the questions to contact CONCACT at UNICOM.
Absolutely. You can either email me direct. There's my email, or you can collate them all and send them to me in one shot. And then what I could do is I could send them back to you, so then you can available to the whole audience. They can email me direct, or they all come via you, and then I can email them out to the whole audience, and you can put them back out again. Okay. Forgive me, I do have to depart now. My apologies. It's to do with family. So have a good day. Bye-bye.
Thanks, Professor Choudhry. So thank you all for attending. As you said, as you see that the questions, if you have any questions, you can either mail it to Professor Choudhry himself, or you can route it out through, and we'll get the answers for you. So you can, for any queries and questions, you can mail it to contact@unicomlearning.com. That's contact CONTACT@unicom learning.com. Thank you all for attending. The recorded version of the video will be available and will be shared with you soon. And all, have a good day.